Welcome to episode 2 of Unlayered, the state of Solana DeFi. And before we dive into all that, Dave, how's it going? What's new?
It's good, Sal. Good. Another busy week in the world of crypto. I don't know what you've been seeing on Twitter, but I think it's been dominated this week by meme coin season. I've been going absolutely crazy, both on Ethereum.
Oh, for sure. Pepe.
Pepe. Did you get any Pepe?
So here's the deal with Pepe. I was kind of keeping tabs on it. I heard initial rumblings about it about 2 weeks ago, maybe 2 and some change. I thought about aping in. So it already at that point had a run up of a few 100%. I was like on Uniswap. I was just like, this smells like a rug. And so I decided not to do it. And now I'm kicking myself because that probably would have been, at least 1,000% gain at this point. I didn't, candidly, I didn't think it would shoot up to $1 billion plus market cap. That's always been kind of my barometer. Like, can it get to that? Clearly it did, but no, I'm kicking myself right now.
It feels slightly strange that we're in this meme coin season because to me, it almost feels like people are just desperate to ape into something and they've just gone for that sort of the most degen thing. And really, it feels like a bad look on the whole space that this is all that people can get excited about. The same, Doge was created, I don't know, way back when, and we're basically still at Doge levels of crypto adoption. So it feels a bit disheartening that this is all that people can get excited about during a bear market.
Yeah, I actually have kind of, maybe not an opposite view here, but it makes me really happy that people are getting excited about meme coins. Certainly meme coins have no utility, but the reason why I get excited is it means that the appetite for this asset class broadly, the risk appetite is still there to a degree, and people are willing to will these tokens into existence and into some semblance of relevance. And so from that lens, as a builder in this space, it just gives me a lot of hope that, the entire space isn't dead. There's actually a lot of parallels to what's happening specifically on Bitcoin with BRC20s. And, we can even just go back to ordinals at the end of last year, beginning of this year, where a lot of excitement around those sort of innovations for seemingly use cases that aren't that useful. It always starts like this. It always starts as a toy or something that's a joke. And over time, I think it will allow, it'll kind of be a gate for people to enter the space and get interested in it. So it's funny. It's kind of a random coin that's useless. But at the same time, the fact that this thing had, and I was reading this on Messari's listserv, the fastest growing token to $1 billion plus market cap ever is Pepe. It gives me some weird optimism that maybe a bull market isn't as far away as we think it is.
I suppose another take that I've got, I don't know if you've ever listened to a guy called Josh Rosenthal who talks about how this is the crypto renaissance and how he sees lots of parallels to the original renaissance. And one message that he always puts forward is that the original renaissance, it wasn't all this high-end art. There was a lot of just memes and low quality stuff that sort of pushed the whole movement forward. And his point that he always puts forward is just don't discount memes. They are actually hugely important, and they may seem silly and irrelevant and stupid at this point, but they are developing this crypto culture and helping push the space forward, as sort of as silly as it may seem.
Yeah, that's a super cool point. Did you say it was a thread or an article for reference? I want to check that out.
He's done a couple of podcasts, Josh Rosenthal, on the crypto renaissance. Really interesting. The other interesting point, of course, has been the congestion that this has caused to both the Bitcoin and Ethereum blockchains, having to suddenly deal with this influx of users and volume. And what are your views on that, Sal?
Yeah, absolutely. It's kind of reminding me of the minting of other deeds last April, so April 2022, when people were paying more in gas than the actual cost of the deed itself. So the gas, some people were paying $2,000 plus worth of ETH for another deed that was worth less. It reminds me of that, and the mania is for a different reason. It's a lot of it has to do with kind of this meme coin trading volume. It's kind of like a great advertisement for why scalable monolithic L1s might have a bright future, where this type of stuff does not happen on chains like Solana. And I think an excellent example to support this is the Mad Lads NFT launch that happened a few weeks ago, where there was just an insane amount of demand for this, where the actual volume for the NFT ranked number one across all chains, including Ethereum, and yet the network never went down. It shrugged off all of the demand. So my view is that, and I was playing around, I saw some some tweets where like some people are paying $200 in gas on ETH. That's terrible. I mean, it's that's not nearly cheap enough be usable for everyday users. You do really have to be kind of a millionaire to transact on a chain that has such high fees. And so, yeah, I guess my gut reaction is great tailwinds for Solana. I don't know. What do you think, Dave?
Yeah, yeah, I completely agree because I think there's been two interesting things. Firstly, ETH L1 has gone crazy with fees, as you say, $250 fees, which basically prices out 99% of the world's population. People can't afford that to interact with the L1. But the other second order effect is the L2 transaction fees have also gone up, in my opinion, way, way too high to actually be usable for most of the population, which is sort of $1, $2 per transaction. I think it's something like 73% of the world's population spend less than $10 a day. So the idea that people are going to, spend a large chunk of their daily allowance on transactions on even on the L2 layer suggests to me that it's just not ready for mass adoption either.
Yeah, that's funny. It's like we try to get away from this legacy infrastructure. We have this quote unquote scaling approach with L2s, and now when the L1's congested, the L2s are just at parity with the legacy infra, where it's a few dollars to send money around instantly. That's kind of hilarious, and that is like the opposite of an advertisement for crypto. That's basically a signal that yeah, we're pretty far away from being useful for most people in the world.
I think when people actually come over and start using Solana and start using the applications on it, a lot of people do have that aha moment. I wrote a tweet actually just this week saying that, I mean, it's completely off guesswork, but my assumption is that almost everyone on Solana has come there from Ethereum, has at least interacted with Ethereum and decided that Solana is where they'd like to spend their time. Whereas I suspect a much, much, much smaller percentage of people who use Ethereum, spend all their time on Ethereum, have actually tried Solana because it's just one of those things. Once you try it, it's very hard to go back to spending even $2 per fee, let alone $250 per fee. It just feels completely different.
Absolutely. And speaking of kind of the difference between Solana and Ethereum, one of the biggest or the starkest contrasts between these two ecosystems is what's happening on the DeFi side for both of them. And I just have the metrics pulled up here. So Ethereum DeFi TVL, total value locked, is 27.54 billion according to DeFi Llama. Solana, on the other hand, is sitting ranked number 11 across all the chains at $263 million. So obviously quite a stark contrast on the order of 100x difference between the two. But again, I think, and this is where we're getting into the purpose of this episode, State of Solana DeFi, we don't actually think that this metric tells the whole story. I think there's a lot actually happening in Solana DeFi, and we'll get into the details of that with our interview with Barrett from Cypher. What do you think? What's your take on Solana DeFi and these metrics? What have you found so far?
Yeah, I mean, there's a couple of things to say. Obviously, Solana TVL has taken a hit. It's taken a hit because of Alameda going bust, and obviously, being convicted of fraud. And obviously, they had a load of money, and also the outages, of course, has potentially reduced confidence in Solana DeFi. But I think it's not quite as clear cut as people say, because if you consider Ethereum, they've gone through two bull cycles, complete bull cycles. They spent most of that time as the only credible smart contract blockchain. So they've basically been uncontested for years now, have gone through two bull cycles. Their market cap got up to over half a trillion last bull market, and it currently sits, I think, around 220 billion. So for me, there's just an element of, if you have that much capital in the base asset of the ecosystem, inevitably a lot of it is going to flow into DeFi. And I think if Solana has a really successful next bull market, if we ever have another bull market, then I think that money will also flow into Solana DeFi. So I don't think it's quite as clear cut as everyone has decided Ethereum DeFi is the only place you can park your money. I think it's more a case of Ethereum holders put their money into Ethereum DeFi, just as I think Solana holders would put their money into Solana DeFi, should we be as successful and manage to get up to these sort of crazy valuations at some point.
There's kind of two forces competing here, right? And you brought up the first one, which is there's a ton of capital already parked in the Ethereum ecosystem. And concretely, what I mean by that is, of this $25 billion, any L2 that attaches itself to the EVM can quickly accumulate TVL. And the best example of this is Arbitrum. If you date back to July of last year, so July 2022, which is, for all intents and purposes, during a bear market, their TVL has 4x'd from about 600 million to $2.4 billion today, which ranks Arbitrum today number 4 actually. And so they rocketed up in TVL very quickly. That's kind of my point. But the issue is, and we talked about it in the beginning of this segment, it still is kind of beholden to congestion on Ethereum. It's not as cheap as maybe we think it is, so on and so forth. Whereas Solana, completely different design space, completely different blockchain, so that you can't really tap into existing capital anywhere, especially after the fall of FTX. It's another on-ramp that's gone, so it's just a little bit harder to onboard new money into Solana. And so its TVL hasn't really recovered since. It's sitting at about 200 million, but its primitives, its speed, its low transaction fees, and just the fact that Solana itself was architected specifically for DeFi in the early days. I mean, their initial pitch deck said NASDAQ and blockchain speeds. And that was kind of Anatoly's initial fascination, was programmatic electronic trading. That's kind of why he built Solana in the first place. It seems really well built for a long-term future in DeFi. But the question is, how does Solana bridge that gap and get to a future where it does have a lot of users and money on the chain? And that's something we'll touch on in more detail in this episode, but just kind of teeing it up for the audience here. Now we're going to move into our interview with Barrett. Barrett is the founder of Cypher.trade, which is accessible at Cypher.trade, and he goes by @Barrett_IO on Twitter. Cypher.trade is a decentralized protocol on Solana where you can access margin trading, perps, and a whole suite of other products. They have a very aggressive roadmap that you can check out on their website. And Barrett is an expert on all things DeFi, specifically on the Solana side. So very exciting conversation where we dig into the state of Solana DeFi and what's to come. So we are joined by Barrett, founder of Cypher. Thanks for coming on today, Barrett.
Yeah, thank you guys for having me. I'm excited for the pod.
Likewise. Definitely an interesting topic here, DeFi and Solana. And we kind of just want to get right into the hard questions here. But Barrett, as we stand here today, Solana is number 12 in DeFi TVL across all chains for a total of about 260 million. This is good for about 1/100th the size of ETH TVL, which is currently first by a good long shot. My question, just to start off here, is it over for Solana DeFi?
I don't think so. The cliche is like we're all so early, but like it actually is still in like DeFi's like life cycle pretty early on. Market, macro environments are all down. Solana's definitely taken more of a hit than other chains, but by no means do I think it's like over for Solana. I think that the underlying tech, it's currently the only one in my opinion that has like the potential to scale to support what DeFi's vision is, in my opinion, which is like being able to replace or accumulate a large amount of the volume that we see in TradFi today. And if you're going to do that, you need a chain that has that path to scalability that can compete with like the NASDAQ, right, which does 429,000 transactions a second. And if you're not getting to those numbers or close to those numbers, I think it's going to be very hard to like really move a significant amount of capital on chain. And so for me, I still believe that like Solana is the place to be, place to build. Obviously our TVL is down, and hey, like, we like the ecosystem is putting out a lot of awesome updates. Protocols are continuing to build and launch. So overall, I'm like pretty bullish on Solana, and I think that some of the things that we'll cover later on in the pod will go into like more detail on why those are.
For sure. You kind of got at this second point, though, which is we have two views here, right? There's the view on Twitter sphere and at conferences where people think Solana DeFi is dead. And then there's the view from people like you who are building in this space. And there seems to be a lot of optimism here. What is that kind of collective feeling you're seeing on the builder side? Are there just projects and things happening quietly that you think could really change the game here for Solana DeFi?
Yeah, I mean, I definitely think that there's like a number of projects that are, out or coming out. I was like reading through some of the like Grizzlython submissions, which I think are like pretty exciting, and what you can build from like no code tooling to for like building like smart contracts, right? And I think that, or at least like on chain applications, being able to link a lot of stuff. They integrate with Zapier, right? Which I think helps ease that like developer experience even for like non-technical people, right? Which I think is again really important. It's one of like the key points about like traditional tech, and like how easy it is to build applications, which blockchain doesn't really have. I mean, ETH is a little bit farther along in the developer experience. I think Solana's made a lot of leaps and bounds in that regard. But some of those like projects coming out from Grizzlython, I think, are really exciting. There are some protocols for effectively enabling people to passively provide liquidity on order books, which I think is really important because, given my background, I'm a big believer in the order book being the mechanism of exchange for assets. And so those are like really exciting to see. There's, Helium is coming online, I think this month or next month. Yeah, so that's like really exciting. And I know there's, some other big kind of like gaming aspects that are going to be launching on Solana, which I think is like crucial for an ecosystem in general, right? You're going to get a lot more users. We saw this with like Step In, right, which wasn't like really like a DeFi app, but interacted a lot with like DeFi applications, right? And provides like a lot of liquidity, right? A lot of users. And those types of applications integrating more into the DeFi sphere, I think is overall incredibly, impactful. And then, yeah, we still have, a lot of like the dexes. And I think that there's some unique things about what you can do on Solana that makes, or is a little harder to do on other chains just because of like the throughput and cost of like actually building on Solana, which I think are important for building these like more robust and complex applications that can attract those large capital managers or movers to bring in that liquidity to the Solana ecosystem, right?
Yeah, completely agreed. And while the costs are low and the latency, is also very low, I think another narrative which people have against Solana is the number of outages which it's suffered over the last 12, 18 months. A lot of people say that layer one should not be doing this, and that therefore there's no point trying to build DeFi on a platform which keeps on having outages every few months. Any thoughts on that, and how critical it is to Solana's future as a DeFi hub?
I mean, look, as somebody who is building in DeFi, it's definitely hard to deal with, right? And it does set the chain back from like a sentiment and user standpoint. I do understand what they say is like when you're building on the frontier, right, of distributed systems, especially for a blockchain in particular. When you're pushing those limits, things are going to happen, right? I'm not saying that it is acceptable, right? We obviously in the DeFi community voiced, I think, a lot of outrage about this last outage, saying that like, hey, this can't happen again, because every time you do this, it does like set the ecosystem back, right? And I think that they have taken it very seriously since this last one and moving a ton of engineering resources to increasing stability, right? I think that we have a lot of really awesome things going on in the pipeline as well, with Jump building Fire Dancer, so a second client, and it's really interesting because it's all from scratch, right? And so I think that that'll help increase the stability quite a bit, also throughput as well. I think dApps as well are, our team has definitely built a lot of like safeguards into the protocol itself for traders that are on an order book, right? Like time and force orders. I know other protocols are doing this or have done this. And so I think that those things are really important to build into your system to make it resilient in the face of these outages, right? And to protect the people or teams or trading firms that are using these applications. But again, like, yeah, we can't continue to have the chain go down because it just sets us back farther and farther. But I do believe that with the change in not direction, but the change in resource allocation for robust testing and adversarial testing, that this will be solved here in the short term, right? I'm not saying that it won't go down ever again, but I think that our probability of going down definitely decreases with the amount of resources that labs is allocating to kind of the scalability or the stability efforts, right?
No, I think that makes sense. Certainly, that has been probably the most consistent narrative against DeFi and Solana I've heard so far. But I think I agree with your sentiment too. It seems unlikely that this will continue being a problem in the long term. And I think it's mostly a product of just how quickly Solana is pushing the bounds, so to speak, and doing things that you really aren't seeing on many other chains. One quick follow up here, though, and I guess the broader point I'm making with this question is kind of how do you measure the health of a DeFi ecosystem on a chain, right? Like Solana had this weird, story that came out last year about two brothers faking about $7.5 billion worth of TVL on the chain, and it was accounting for tens of percent of all the TVL on Solana. And I already kind of had this view that TVL is not a great way to measure this stuff anyways. The question I'm driving at here is, how do you respond to like that story people sometimes bring up, and what is like maybe a better way to measure DeFi health on Solana or any other ecosystem?
I definitely think like TVL is a important metric in the sense that like it does show you how like some proxy of assets on chain, right? I don't think that it actually did more damage to Solana's reputation than network outages or congestion, because it's not like that happens on other chains too, right? I
Yeah,
think like
it's gamed everywhere.
it's gamed everywhere, and it was like created like it was like what Saber, which is effectively like
Yep.
curve, right? And then Sunny was effectively like convex. I think like the difference is that it was just built by one team of people instead of like multiple teams. I don't necessarily see that being yeah, it like created a lot of TVL, but this isn't like just a Solana thing, right? There's like all these like circular sharing leverage mechanisms across all these ecosystems that help boost TVL. I think that the TVL metric is like, hey, this is the premier metric for DeFi, is a bit off. I think when you have a chain that a lot of the trading activity, at least prior to FTX Alameda, was order book based, right? And those are just more efficient systems than like an AMM in that for exchanging of assets. And so TVL can be lower because a lot of the volume or trading activity does go through order books, because it's just more capitally efficient, right? And so I think that if you really want to look at how healthy a DeFi ecosystem is, you need to look at metrics like what Ben Sparango put out on like velocity, DeFi velocity for dollars that are on chain. I think there's a lot of metrics in regards to cost per trade, right, that are important for a DeFi ecosystem. Like, what is my price impact per block of size, right? Like $1,000, $10,000, $1,000,000, right? And I think that those are really important metrics to look at, and they'll still be a little different, right? Because maybe like an order book doesn't have $1,000,000 of liquidity on it immediately, or couldn't like, if you wanted to place like $1,000,000 market buy on an order book, that might not, you might have like a lot of price impact, but if you are doing it in chunks or place a limit order, right, there's a lot of capital that's on the sideline that these market makers do have that are going to come in when their order gets lifted off the book, to replace that, and again like maintain this healthy cost per trade, right? And I think that those are like more important metrics than TVL. I do think TVL is an important one, and I think unfortunately it is like what everybody defaults to. So you do need to have like a relatively strong TVL, but I think for DeFi activities, there are better ways to quantify the health of an ecosystem as opposed to just looking at TVL.
Yeah, it's actually a very good point you brought up here, which is pre-FTX at least, Solana was mostly being driven through on-chain order books, and those are by nature capitally efficient, which means they necessarily wouldn't inflate the TVL the way something like an AMM, which is not capital efficient at all, would. I think that's a very, underappreciated point. David, we were just talking about this actually, this kind of dynamic between central limit order books, we call them CLOBS, and AMMs.
Yeah, we pulled earlier the information that you were talking about DeFi velocity. And as you say, Solana came up to about 1.83, and something like Tron, which has maybe the third or fourth highest TVL, has 0.01 as the ratio. So I think TVL as a lone metric, it does miss this sort of aspect of, well, how much is that capital actually being used? And therefore, how much yield can you actually expect to receive deploying on certain networks? And I'm sure that Solana's cheap fees is part of the reason why we're seeing so much velocity with the DeFi.
How did you calculate that? Was that just TVL over 24-hour volume?
Yeah, the way Ben had done it was on 24-hour and 7-day volume.
Gotcha.
So I think he just went on DeFi Llama, just did that simple calculation of volume, trade volume versus TVL.
Just scrolling through I'm on DeFi Llama right now. It's like Solana is at $42 million for 24-hour volume. You go up to rank 11, DeFi chains 3 million, then 3 million on Kronos, 2 million on Mixin, then Phantom's the next one that's in that ballpark with 33 million. But I don't know. I think that's an interesting way to look at it too. So sorry for the sidebar there.
Oh, no.
And you were just touching upon this, Barrett, but maybe it'd be good for the listeners if you could just go through the differences between an AMM versus a CLOB versus a CLAMM. Yeah, and where you see the direction really of trading going forwards.
Yeah, we'll start with an AMM because I think that that's like the most familiar for people. An AMM is just a mechanism for exchange where retail or individuals can like passively provide liquidity on like a trading pair. So Sol USD, for example, they're going to deposit both sides of this asset into a pool, and then people can come and trade against that pool, right? They can buy and sell into it, and the liquidity providers, the people that are depositing the assets into the pool, earn some fees from trading fees and sometimes token incentive as well for being in that pool, right? CLMMs are just like an extension on top of an AMM with like concentrated liquidity. So you can kind of like set bounds where you're going to be actually providing that liquidity, right? So it's a little bit more efficient, a little bit better of a mechanism. You still have a ton of like extra TVL that isn't really being utilized, all the time. But like the mechanism is very much similar to that of an AMM. And an order book or CLOB, which just stands for like central limit order book, or I think now is like becoming a DLOB, a decentralized limit order book. And that is kind of like the traditional mechanism of exchange in like TradFi on like the NASDAQ, the CME, et cetera, where you have people quoting or placing orders to a book, right? But what a book is just like there are people that are trying to buy assets and there are people trying to sell assets. And then when you cross the spread, so if you're trying to like buy and you hit the lowest ask, right, your order gets filled. Or if you like place a limit order, it just sits on the book, price moves, it can get filled that way. And that allows you to take no price impact, right? Like you're like, hey, I set my own price. If it doesn't get hit, it doesn't get hit. If it gets hit, I get filled at the price that I wanted to buy at, right? Which I think is the way in which you're going to attract a lot of these large traditional institutions because it is a mechanism that is familiar with them. That's how they interact today. So it makes sense that this is how, you'll kind of see this big, volume in TVL kind of make it on chain, right? I also am biased, obviously, given, my background and building on Solana was like, it's fast, it's cheap, they have a CLOB, great. And so I came to build on Solana because it was fast and cheap, and there was an order book already built that was on chain. And then on the AMM side of things, as an LP, this has, become more of a topic in the last I don't know, what, 6 months or so, about how it's not very profitable to be an LP, right? So if you're a retail person, being an LP, you're not actually making money, and other people have different views, right? But the data shows that you're in fact like losing money on average, being an LP, right?
Just to clarify, you're referring to liquidity providers for AMMs
Correct,
who are
correct.
providing capital for the pool. Right, right, right. And you're saying they're not making they might be making money in absolute terms with fees, but you're referring to like impermanent loss in terms of like the economic profits over time.
Correct, correct. And I think that that's like the real important metric, right? Is you need to be like, am I making money based off of what I am like providing, for this pool? And so that alone makes me sway towards like an order book being a better mechanism, of exchange. Although AMMs do have their own benefit, right? Like for long tail assets, that might not have like people interested in market making on an order book, an AMM is still kind of like your go to for that, right? Like if you're launching a brand new, token, an AMM is like great way to get started because you can have people like Password Provide. But as like it scales, it makes less sense to use AMMs over order books, right? And I think there are some interesting mechanisms coming out, for people being able to kind of deposit into these mechanisms, that are managing trading on an order book, so you can kind of treat it like a it's like a vault effectively, which means that like you deposit the assets, this vault will then go place trades and remove trades, in real time on the order book. And I think that that is a good way to help build liquidity for these longer tail assets on an order book, while I believe like being better for more profitable for those, liquidity providers, to this like vault mechanism as opposed to being on an AMM, right? Because like on the CLMMs, as well, if price like moves out of your range and you don't update it, you can be very great. Like you can have like great impact on like what just happened on your profitability. And they have some like really cool things like, vaults, for that as well. But again, it's still kind of tied to it being an AMM, and the majority of flow on an AMM is just toxic takers or toxic flow, in the sense that there is some arbitrager going, this is an out of priced asset. I'm going to come in, or buy and sell to take, like, be profitable on my side, and LPs kind of just have to eat those losses.
Gotcha, gotcha. I want to kind of summarize some of the points we made for the listener as we kind of dive into this very technical topic here. I think one thing that's clear is there's a few buckets in terms of the design space for trading on blockchains or off chain, right? Right. Like there's Binance and Coinbase; those are centralized exchanges, and that's pretty much how TradFi works. They have their own order books, they're scalable and they're capital efficient, but there's no decentralization. They're not on chain, and so that's why DeFi kind of exists. And one thing we talked about initially was the AMM model, which are scalable and decentralized, but not capital efficient at all. And then there's this other bucket where you have on-chain CLOBS or CLMMs, which are decentralized and capital efficient, but perhaps not scalable. Kind of high level, tends to be where the debate around all three of these approaches falls into. And one question I had with regards to that is with the emergence of things like Uniswap v3 and the concentrated liquidity, which we touched on a bit in this conversation we just had. Can you help us and like the listener, elaborate and hone in on why central limit order books on chain are still superior, perhaps, to that model that Uniswap v3 is pushing and these other kind of iterations on top of the AMM model?
Yeah, of course. Even on Uniswap v3, like LPing, or being a liquidity provider, right, and setting these bands in which you will willing to quote at, you're still losing money as an LP, right, on average. And so I think that that is like the biggest reason that an order book remains supreme as a trading mechanism, at least for the assets that are doing a lot of volume, like your majors, right? And even like your top DeFi tokens outside of that as well. And I think that, again, as you have more sophisticated traders coming on, you will see that AMMs, and CLMMs in particular, because that's, I think, where it's going, are still not profitable for an LP as these, TradFi groups, these quantitative hedge funds come on and they go, well, this is free money, right? Why am I not going to take this free money? And so I think that on that alone, you'll see more volume kind of move towards the order book and these mechanisms that are enabling everyday users to quote passively on an order book, right? And deploy these automated trading strategies.
Do you think it's any different with these Oracle style DEXs popularized by GMX? Are the LPs still losing money? Is it still, full of toxic order flow?
I haven't done enough research on the profitability of LPs on like these Oracle based DEXs like GMX, for example. I do believe that there are definitely arbitrage opportunities because it's an Oracle. If you can get, the Oracle update before it is, transferred to the DEX, then yes. I think from a size wise and a volume, it's hard to scale those because your LPs are taking short positions, right? And I think we've seen on a number of these forks, and maybe GMX included, that there comes a point in time where people can't really open up trades anymore because the OI is reached its capacity as like LPs are taking the short side, right? And that doesn't really happen on like a traditional order book. I think those models are really interesting and really exciting for retail who are like, yeah, like I'm going to trade, thousands of dollars, maybe $1 million, right? But when you start to like deploy, or people are deploying like really like a lot of size into them, then you run into those constraints of those mechanisms themselves, or like the risk that it poses when somebody has amassed like $50 million on one of those like Oracle based DEXs, and what happens when they become very profitable, right? And then we'll see how that really impacts those systems. I think that for small size, it's really really cool, really interesting. You can get pretty high leverage on those, but I still think for large trading operations, if you want to replace a centralized exchange, it'll be very hard to do it on a zero slippage Oracle based DEX.
You're almost relying upon pricing from another venue, aren't you? So you can't really replace a SEX because you need a centralized exchange, or you need some sort of driver of price to tell you what it should be. I saw a tweet from yourself actually the other day where you said no centralized exchange is safe, and we're going to see a mass migration of volume and capital to on-chain trading venues. And I believe that you consider Solana to be one of the obvious locations for that. Do you want to just go more into that, and ideally about the difference between a centralized exchange order book and what can be achieved on a decentralized exchange on Solana, for example?
Yeah. I mean, like the order book operates the same way, right? Except for it's on chain. That means that the big difference is if you're trading on a order book that's on chain, it's self custody, which I think is the beautiful and beneficial thing of DeFi, right? Is it is self custody, and you can't have what happened with like FTX, where Sam defrauded everybody and took everybody's money. And I think that that's like the really big advantage of these decentralized exchanges. Also, the access to the global population, right? I think on these centralized exchanges, there's a lot of geography based limitations. But when your application sits on a blockchain, theoretically, you have access to anybody that is using that chain, right? Whether they're in Southeast Asia, the United States, South America, right? Everybody can participate in that system and really make a global financial market happen, which I think is like the most exciting thing in one of the biggest advantages of these decentralized order books, right?
Right. No, I think that's a good point. I think one other sort of takeaway from that tweet, which it seems to be implying here, that Solana is kind of the heir to the Iron Throne, so to speak, for this maybe SEX activity that will leave centralized exchanges, especially post FTX and post realizing all the dangers of custodial based exchanges. My question though is, Solana's in this weird rut right now where there's not a ton of liquidity in DeFi compared to other chains. Obviously, not a ton of TVL. And so it doesn't, at least on the surface, doesn't seem like it's quite ready to absorb billions and billions of dollars of activity overnight. So how do you see this kind of transfer of power almost where, yes, the tech is good enough, it's fast enough, and there's a lot of cool primitives, central limit order books on chain ready to kind of take the mantle.
Mhm.
But how do you see this playing out over time tactically?
Yeah. I mean, I think like with the migration, right, you'll have people taking their liquidity and moving it on chain, right? So as of today, maybe it can't support, Binance activity. But as trading groups and traders move their liquidity on chain, it will naturally pick up, volume will pick up, and it then creates that flywheel effect where it's like, okay, like, hey, now I'm a bigger hedge fund. The smaller ones made the leap already. I can now like make it to this chain to like start to trade, right? And I think that is how it happens because there's a lot of teams doing a lot of work right now, bringing small to even some large market makers into the Solana ecosystem to kind of help prepare for this migration that I see. I think a lot of other people also would agree. Maybe not with it all going or a lot of it going to Solana, but at least on chain, right? And I think that's like the biggest factor and how you're going to like build that liquidity base. I think also these groups are going to look for places with order books, right, that mimic the centralized exchange. They have to do a lot less for changing their tech stack to start trading somewhere, right? And if you can support an order book, you're on higher ground for attracting these traders that are going to be leaving these centralized exchanges to try and quote in DeFi, right? And I think that's like the big draw is that the infrastructure and primitives are there to make the transition as easy as possible for these groups. They have to change less for how they quote their pricing models, right? As opposed to like going and trading on like zero slippage or AMMs, right?
Right. I think this is actually a good segue to talk a bit because you mentioned bringing on market makers over time to your work actually as the founder of Cypher. Can you talk to us a bit about what is Cypher? What was the initial vision? Because as I understand it, it's changed since when you guys did a fundraising round in 2021 and versus where you're at today. Give us a bit on the story of that.
So Cypher like originally started as a DEX for pre-IPO assets, right? One of the really awesome like ethos of DeFi is access to financial markets for everybody, and obviously private capital markets are very much excluded for people, right? It's this very tiny percentage of the population that can actually invest in this asset class, and so we originally were like, okay, let's build a DEX for enabling people to gain exposure to these assets. Now, they wouldn't have the underlying itself, but they would have that exposure to the price of these of these private companies. And I thought that was a perfect fit for DeFi. We ended up making pivots for one reason or the other to kind of like where we are today. And I think a lot of that had to do with seeing the liquidity fragmentation of DeFi. You typically go to one venue to trade perps, another venue to trade options, spot, etc. And if DeFi really wants to compete on like the global stage against traditional markets or even centralized exchanges in crypto, you need venues that can enable trading of all of these asset types at once, right? And that's what Cypher has like evolved into over a couple iterations. And so on Cypher you can trade spot assets, you can trade perps. In the future, it's already on mainnet, but we just haven't like turned it on. Dated futures, options, right? We natively support borrow lending, so it's kind of this like a one-stop shop super app for all your DeFi needs. And that is to kind of help, bring liquidity together, unify that liquidity, but also provide a place where whether you're a retail individual or a trading shop, you can manage a sophisticated portfolio from one venue and maintain capital efficiency, which I think is like the biggest piece that DeFi struggles with, is that capital efficiency. And now, since Cypher supports cross margining, you can have all of these assets, manage all of these assets in a particular venue, which improves your capital efficiency, which means spreads can be tighter. You can have more volume, more users, borrow lending, and applications can then be built on top of Cypher's infrastructure to kind of utilize everything that has been built, right?
Gotcha. So certainly a lot to unpack there. Super cool platform. I think one point I want to hone in on here is it sounds like, and you already said it, but Cypher is a bit of a super app for DeFi where traders can express certain views on assets, whether through spot or options markets, and do the borrow lend inside the same venue. And you kind of have almost economies of scale here where you can now do things like cross margining. Can you dive a bit deeper into that? Like, why is that so crucial for the end user and broadly better for DeFi? And how does that work?
So enabling the trading of a number of different financial instruments allows for more capital efficiency. And what I mean by that is that these market makers a lot of the time are delta neutral trading shops where they are trading one market, offloading risk into another market, right? So we could use like perps and spot, for example, right? Like a market maker is market making perps or spot. Depends on which one that they or both, right? And they fill an order on the perps book. That reduces their capital efficiency until they offload that risk, right? And traditionally, you're kind of doing it across a couple different venues, right? So you're, getting filled on perps on one venue, you have to manage that like margining system over there, and then you're offloading risk into another, venue, and those don't talk to one another, right? And so once you offload a risk and have become delta neutral, you still aren't benefiting from that like capital efficiency where then you can take that capital and use it again, right? And that's one of the big unlocks that I think Solana enables. And what Cypher's kind of like core principles are built around is now that you can trade all these assets classes, offload risk. The system understands that you have offloaded that risk, and you get your users get their capital back, right? Because they have either sold an asset or bought it back. Their margin is then increased again because the risk has been mitigated, right? And I think that enables more on like this DeFi velocity thing, right? That Ben has like tweeted about. Dollars go farther, and that enables market makers to quote tighter spreads, right? When they're able to benefit from that capital efficiency in one system. What that means is that users who aren't market making are benefiting from better execution prices, right? And there's like the flywheel that begins with that kind of fundamental capital efficiency in margining, right? That I think is really beneficial and can help DeFi scale to reach these, centralized exchange volumes, right? There are some centralized exchanges that offer, 1,000x leverage, right? And I don't know, and like some DeFi apps
Yes.
like enable that, right? But I think that you don't necessarily need that much margin or leverage, right, to achieve the goals of capital efficiency to build an incredibly robust and healthy ecosystem. And I think that that's kind of the goal of Cypher and why we have structured our protocol the way it is.
So just to summarize, see if I understand correctly, but you're saying previously, most programs, if you're going to go long on one application and then go short elsewhere, it's not going to realize that you're actually delta neutral and that you should be able to redeploy capital. But with Cypher, it would allow you to do that. Can you just clarify, do you have to use Cypher products to achieve that, or can you be using other applications, for example, Drift, and it will still know that you're delta neutral? How does that work?
So it is contained to Cypher's ecosystem currently, right? Due to the margining, like margin accounts, right? Like Cypher's protocol maintains a margin account, and if the assets are not held in the margin account, the system cannot guarantee that you're in fact delta neutral, right? Now, not to say that in the future it can't be done, but at least in this iteration, it does contain to Cypher's ecosystem itself. Although our spot markets are open book, which means that it does share with a number of different applications, right? And unifies that kind of like spot liquidity. Also, Phoenix released, recently, and our team is working on, integrating Phoenix because I think that they have some really awesome infrastructure, being like a crankless order book, as opposed to, open book being, you have to crank it to, continuously settle those, trades on those markets. And so that's like the big benefit is that unified spot layer, which is typically where a lot of people are going to be offloading risk into. And so that's like where we started, right? And with, everything else on the derivative side, that is definitely, Cypher native order books. But in the future, we're looking at integrating, or we're working on an integration for Jupiter, which kind of enables even more access to liquidity because they do integrate with AMMs that are not necessarily integrated with open book, right? And so you can have like better spreads and offloading risk, allows again like that tighter and that like liquidity flywheel to take effect. Would be definitely something that we're interested in figuring out, is how do you enable delta neutral for derivatives on platforms that are not Cypher, right? And I think that it's definitely it's feasible. I know teams that are working on it right now, and so definitely excited to kind of get to that where maybe there's another protocol on top of Cypher that has its own margining system that ties into a lot of dexes, and Cypher can be one of those, right? And I think that that's like the beautiful thing about composability, DeFi being building blocks.
Yeah, that's exactly what I was just about to come on to. Because, firstly, I thought maybe MarginFi was building on top of various dexes and allowing for this realization that you're in a delta neutral position across different protocols. So it'd be interesting to see how that progresses. But the overriding message I'm getting here is the composability of building on Solana. And I just want to compare that to, for example, DYDX's decision to move to an app chain on the Cosmos ecosystem. What do you think are the benefits? Is it that loss of composability, which is the main detriment? What are your views on going app chain versus building on a general purpose blockchain like Solana?
I think composability is a big thing for that, right? Although I'm not 100% positive on like what you can do on DYDX's app chain. Like, can there be another protocol built on their app chain to utilize kind of like DYDX liquidity? I'm unsure about that. I do think that there's some things in the Cosmos ecosystem where you can have composability between app chains, but I think having a universal layer that can scale on its own to support a ton of different things, whether that be gaming, NFTs, DeFi, right, and a lot of different applications. I think you have better access to liquidity, more assets, and it makes composability a lot easier. And so I personally am more enticed to build on a chain that kind of can support all of those and still scale, as opposed to going and building my own app chain, right? Because I think that there are a lot of like liquidity flywheels and composability benefits that come with kind of being on a layer one that can scale to support that type of volume.
Yeah, it kind of said differently, but similar point we're making here is let's call them purpose-built layer ones for DeFi like Psy, Canto, where they kind of have as a core primitive to the layer one an order book type mechanism. I'm not an expert on these, but certainly there's a lot of conversation around those ecosystems. Perhaps what I think these other approaches are missing is the liquidity flywheel benefits of having robust ecosystems that are not strictly DeFi. For instance, Step In, which drove all-time highs in Orca's volume and caused them to make their own decks. We brought up gaming earlier, even NFTs and NFT-Fi and the intersection of those two. That, I think, enriches DeFi indirectly. And we can also get into DAOs, DAO tooling, right? But I think the point is like Solana has this kind of rich tapestry of ancillary ecosystems in crypto that at the end of the day, everybody needs to move money around. And having powerful DeFi primitives plus these ecosystems on one monolithic layer that's composable kind of guarantees interesting use cases and widens the design space in a way that I haven't quite seen in other ecosystems.
Yeah, 100% agree with that. And it'll definitely be very exciting to see kind of these, bigger projects migrate onto Solana, like Helium. They bring a ton of tokens from their ecosystem, right? And I know that there's like a couple other things that are going on that I can't talk about. But I definitely am or like Hive Mapper, for example. Like there's a lot of these like very large scale, not DeFi focused applications that are bringing a lot of tokens, a lot of users, a lot of volume. STEPN being like the original one, I think, that are going to really benefit the DeFi ecosystem in Solana. And I think one of like the original pioneers of this was DeFi Land, right? Which was like the little game that was like, oh, I have like, it's like Farmville, but DeFi, where you're actually like liquidity mining by like doing things, right? And there's like a lot of like really cool mechanisms that you can build because of what you just mentioned on like the having this monolithic layer that can support all these types of protocols and projects.
So we talked a lot about maybe the supply side of Cypher, like what market makers want and how they can express different views they want to take and make their business more viable. What about the other side, like user growth? What we're seeing in layer twos, especially these days, is airdrop farming and incentivizing with tokens. Whereas maybe we haven't seen as much of this. At least I haven't seen as much of this on Solana. Like, do you have a view on why that's the case?
I think we didn't see that all that much on Solana because kind of like the first, like DeFi 1.0 on Solana came about in a bull market, right? People were able to just perform IDOs, have very successful IDOs. There was a lot of liquidity here, right? And so, and also it was in a bull market where, it was pretty detrimental to like use a chain that was, with a mempool that has, like dynamic base fees in the sense that like it can get very expensive to transact. And if you want to move in and out of positions, right, it wasn't really the place to be, right? And that's like Solana like boomed over that, right? And I think that will happen again when we start to see like it become incredibly, like as gas fees increase and people are outbidding you, people will again migrate to kind of these L1s that are performant and have incredibly low fees. L2s I think will also see a big boost on that front. And I think that now after being through like a cycle on Solana, you're going to see airdrops coming here in the near term. I mean, we've already seen stuff come out from Tensor, right? And I think that there are more protocols that don't have tokens currently, which is a ton of like Solana DeFi actually, that are going to be participating in these mechanisms because it is a great way to attract users, right? On Solana, it was a lot of like liquidity mining incentives, which aren't like airdrops per se, but they help bring users, bring liquidity. And now it's in the depths of a bear market. Macroeconomics is, that environment is not necessarily super appealing. Treasuries are, earning better yields than a lot of like on-chain lending for stable coins, right? And you have to be creative, right? And props to the Arbitrum ecosystem for, participating in really giving out a lot of airdrops, a lot of free money, and people want free money. So I think that's going to be something that is over the next like 2 quarters on Solana, you're going to see a lot more of that. I know teams that are working on how they're going to do their airdrops. I know there are some other individuals that are going to be, helping airdrops to the ecosystem that are not necessarily like protocols, which I think is good as well, to just bring more excitement, more trading volume, and more users to the ecosystem. So I think that there's like, and that kind of goes into like how are you going to attract these firms coming from centralized exchanges is these airdrops that are very popular in a lot of the like private and alpha chats across the ecosystem. So excited to see who's going to go first, and kind of like the excitement that's going to be built around that.
Airdrop season around the corner.
No, it's super exciting because it just creates so much goodwill, doesn't it, around not just that DeFi application, but like the whole of the chain, really. There's this flywheel effect that comes about because some could argue, but the TVL would just move from, one protocol to the next. But I think the difference between, you mentioned Arbitrum earlier, they're going to be having airdrop hunters going across all of those different L2s, fragmenting the liquidity. Whereas on Solana, it's all staying on Solana. So, maybe they're moving from application to application, but hopefully they'll create this flywheel effect where the TVL is increasing as more and more people are searching for those airdrops. Just to pivot onto fees for the moment. I mean, a lot of people say the fees are too cheap on Solana, but do you have any thoughts on that? And for example, what level of fees are required if we're going to have this CLOB on chain? What sort of fees can these market makers stomach?
I think there's a lot of opinions on this. My personal opinion is that you can't really increase like base fee much at all, right? I think that as you want to be competitive with a centralized exchange, and it's incredibly cheap to quote on a centralized exchange, right? And if you're canceling orders, placing orders every slot because prices are moving, right, that can get expensive, and these market makers will shy away from a chain that has higher base fees, especially when they're on the HFT side of things, right? And so I think that that's something like really important to pay attention to. The real way for Solana to become like profitable for its validators is to have a blossoming DeFi ecosystem, right? The priority fees for making it into a block, and the rise of Jito's client, being able to receive benefits from searchers as they tip, right? Those are going to generate a lot more revenue for validators as opposed to just increasing the base fee, right? And I would make the argument that if priority fees and MEV payments do not make validators profitable, increasing a base fee is not going to do it either. And so I think that the real way is to create like the flywheels and have a DeFi ecosystem that can compete with these big centralized exchanges and TradFi groups on volume, because they will inherently benefit more from MEV and priority fees than a increase in the base fee. So I'm on the side of the argument where we shouldn't increase base fee at all, because it reduces the attractiveness for quoting on chain. And I think that the order book, again, is the biggest way to bring the most liquidity, the most volume, the biggest DeFi ecosystem into the blockchain space, right? And so that's like how I think about it. There are definitely people that are going to disagree. Validators are going to be like, "Yo, I want that base fee," but I think that over time it will be more beneficial to not increase the base fee and have priority fees and MEV payments take the work of that profitability and revenue stream. And now from that, right, there are obviously MEV payments and priority fees are volatility dependent, and you don't necessarily want incredibly volatile markets either. Like crypto is just more volatile in general, at least for the time being. Is it's still low liquidity comparative to TradFi markets, right? But you can then create financial products for validators, or they can utilize primitives that are already built to hedge their operational expenditures and revenue, just like a commercial agricultural group hedges their corn, right? They sell, dated futures. You can do the same. You could even have some pretty cool things that we've done a little bit of research on, where you have kind of like almost like a swap in the sense, but like it would operate more like a dated future, where a validator can short sell their rewards for the future. Somebody can, buy those in USDC, and that kind of like helps them guarantee some like revenue stream. Obviously, they're going to sell most likely below market price, but they have a predictable revenue stream in that way. As MEV and priority fees will fluctuate throughout the year naturally.
Yeah, I completely agree. And yeah, I think if Solana is going to become a thriving L1, DeFi is crucial to that. And having low fees, currently the lowest in the industry, would help to attract these market makers. I think the one point I'd push back on potentially is the base fee. So different transactions use up different levels of compute units, they're called on Solana. Solana has a limit by which how much they can compute basically every single block. So I know that at the moment there's discussions around, well, we should maybe tax these more compute heavy transactions, and a lot of those are MEV type transactions. So to me, there's some sense to that, because otherwise everyone just fills these blocks with these very computationally heavy MEV transactions. But I'm completely in agreement as well that DeFi needs to flourish, and you need these super low fees in order to compete really with the centralized exchanges.
Yeah, and I like generally agree with that. I do think that if you add additional tax on compute, and maybe this gets solved with like runtime v2, right? But the more CPIs you do, which is a cross program invocations, right? Your computer is going to go up, which means that you're going to tax these applications that are building very complex systems that are going to be able to be the ones that are competing with your centralized exchanges, right? And so if you're a cross margining solution and you're across a number of different dexes, they're going to get taxed more. But those are also the protocols that are providing the most benefit to bringing a lot of this volume and liquidity to Solana, right? And so I think that there's a lot more discussion to be had on that topic. I definitely think it is interesting, and I think that in the right way it could work. But I would be, at least initially, like a little concerned on like the impacts it has on complex financial protocols that I do see being the way that you're going to help bridge the gap between the on-chain and off-chain markets.
So we did a lot of discussion here on kind of like the base level of DeFi, what's happening at the protocol level for all these different applications and stakeholders. But one question I always ask myself and like to ask builders, especially in DeFi, is how do we think the user experience is going to shake out over time, right? Like right now, we're aping into coins straight up on Jupiter or something like Uniswap or at the aggregator level. But over time, I have this thesis that these protocols get pushed down the stack and commoditized, and fees kind of trend, maybe not necessarily to zero, but certainly trend downwards with increased competition. And you roll up into like what people use to do these transactions. Maybe it's even just looking at the fact that MetaMask made a ton of money adding a massive 85 bip spread on all in wallet swaps. It's interesting to see that dynamic play out. Like, how do you see the user experience playing out? Like, who's going to actually like collect the rent, so to speak, at the end of the day?
I think you will see a lot of fees go lower and lower and lower. I think that it will be kind of on how you interact with a protocol, where maybe you're like a liquidity provider or on an order book based protocol, a market maker, where you're earning rebates, right, from the system itself. And the protocol does like pick up less and less, but there are like the flywheels of scale that come into play, that like if you're picking up a couple pennies, a dollar, depends on the size of the trade, right? Multiple dollars, right? That volume game is really how you're going to make money, right? And that's kind of like the thesis behind like the swaps in MetaMask. I think also applications that control risk will be able to maintain higher fees because of those reasons, that they, provide more capital efficiency, right? So, protocols that have leverage, they will always be able to kind of like have higher fees than something like an AMM or kind of like the base level order book, right? Because they are providing, a service that has risk, such as leverage trading. And so I think that the more complex applications will be able to kind of take a little bit more on that side. Obviously, it will go down over time, but they will still, the higher you are in the stack, the and your user, uh, archetypes are going to depend on how much fees you can generate as a protocol, right? And I think that, there's a lot of good incentives that can be done with, the native token for a protocol to help reduce those. I mean, like Cypher, when its token goes live, you'll be able to hold Cypher token in your margin account to reduce fees, right? So you can get to that, rebate level or almost zero level of fees anyway by holding the token. And that's like a good utility for kind of a lot of these like trading protocols to get that access. And those retail individuals benefit from that. Maybe they are paying a higher fee because they don't hold a ton of the token, but they benefit from the flywheel that creates where spreads can be tighter. So their their execution prices are generally just better, right? And that provides like a better UX for them. I think it'll be really interesting to see, how applications are interacted with. I think the rise of, wallets doing swaps, they're not really on the leverage side of things or perpetuals or like the derivative contracts yet, but maybe that happens in the future. I think, backpack and XNFTs are going to be really exciting, and how it's like building the app store, right? And so I think that it'll be interesting to see how these protocols are interacted with, right? Like DeFi Land was a game that interacted with DeFi protocols, and that's like a complete abstraction. And so it'll be really cool, I think, to watch how users really interact. I think that for trading, it will always be some sort of like trading interface, right? Whether that is a wallet, whether that is an XNFT, whether that is, a front end directly on top of like the underlying protocol, or maybe multiple abstractions, right? But I think that it'll be very exciting to see it all play out, especially with some of the stuff that, the teams that are building currently, like, Backpack and Armani. And then I think even Runtime V2 goes a step further on what can be done, because at that point you have unlimited invocations. I mean, not necessarily unlimited because there's like a transaction size limit, but the composability aspect goes exponentially up because of how you can use a CPI to call just a function of a protocol. And it operates much more like the move VMs do on, Aptos and Sui. And I think that there's a lot of really cool interfaces and interactions that will derive from that new unlock of compute resources and composability, because of this current CPI depth is, I believe, 4. In at again runtime V2, it becomes theoretically unlimited, right?
Kind of like related to that point, because I see two major headwinds broadly to DeFi adoption, certainly at least for retail users. One is like just making the user experience better, not having them go to like 5 different websites to do like borrow, lend, trading options, which actually seems like Cypher solves a lot of that by in-housing those functions in one interface and giving the user those economies of scale. But kind of related to that, though, is in order to truly replace, let's call it like TradFi, we need to start letting people take credit under collateralized. And I wonder, like, how does this really shake out over time? How do we actually solve this? Like, it seems to me part of the issue is just this idea of how do you figure out identity on chain and attribute actions to a human being and then use those actions to evaluate credit worthiness. I'd be curious to hear from your perspective as a builder in DeFi. Like, how do you see this playing out over time?
I think initially that will come from on-ramping solutions, just being better. They're on-ramping, you can do things with like a credit, you can buy like crypto with a credit card, right? And that's effectively like under collateralized lending to an extent, right? And I think that will be like kind of that first generation of, okay, like, hey, like we can put credit on chain. And it does like offload the risk from like a DeFi protocol to kind of like that on ramp, because once the assets are in, some protocol, the assets are there, right? And I think that's kind of going to be the first wave. We saw, what is it, Maple Finance,
Yep.
and I believe it's Credit or Credora. I get them confused, and that's really bad.
So many.
But they are also doing like kind of like this under collateralized lending, or ZK proofs for, I think it's Credora. ZK proofs for, showing that a party is in fact good for the money, right? And I think that as that becomes more scalable, you unlock more and more liquidity flywheels, of course. And I definitely think that real world assets migrating on chain, I think that one is CredX. And so I think that those are going to be exciting ways to unlock a ton of liquidity. People take liens against their house. Not saying that's a good idea or anything, but people do that, right?
Yeah.
But being able to like collateralize on-chain positions with off-chain assets, I think is going to be a major unlock for a ton of liquidity. I mean, it's probably to the tune of trillions of dollars, right? And I think that those building blocks are being tackled by teams currently. And I think that once those get more robust, you'll see kind of like this step up of liquidity that is on chain because of these real world assets and under collateralized lending mechanisms. I think identity is a huge part of that, right? And if you can verify that somebody has like a number of different wallets and so therefore they're good for the money, maybe on the protocol itself it's under collateralized, but they have some repo authority or something like that in like a permissionless way to be able to protect themselves if there were they were to like move a bunch of assets off chain and no longer can be verified, right? But I think as in the next couple of years and on into the future to 10 years, right, you'll be able to kind of have like this on-chain representation of somebody's total assets, right, that they do have, and be able to provide liquidity for that on chain. And maybe that's not for trading, right, but maybe it's for getting a car loan, right, or something like that. And I think that all of that can still be incentivized and utilized by on-chain protocols, right? And in everything that is on-chain necessarily won't be decentralized from like a governance standpoint. And I think that that's okay. Maybe that's a controversial opinion, but I definitely, there will always be applications that, are going to go down a different route than, being like DeFi and the ethos of DeFi, but provide a lot of benefit to DeFi's ecosystem.
Yeah, I think that'd be awesome, wouldn't it? If we can get identity working on chain, especially using zero knowledge proofs, it just feels like it would be such a huge unlock. Suddenly freeing up all of this credit really into blockchain. I think the other area which needs more work is being able to borrow at a fixed rate, which is more complicated than it sounds, and you have to develop these huge interest rate swap markets, highly liquid, with massive market makers. So again, I think that's a sort of 5-10 year project. But if you can suddenly have under collateralized loans at fixed rates of interest, then suddenly you can start talking about, buying a house and financing that via DeFi rails. So super exciting. Just to close out, but we saw a tweet earlier in the week from Mert, from Helios Labs, and he said that he's hearing rumors that Solana DeFi is coming back much sooner and stronger than you think. Just wondering if you're able to shed any light, any news, any alpha on that.
Yeah. So I mean, we're starting to see an influx of market making groups that are like, hey, we're interested. We want to be on chain. We want to be on an order book. Solana makes a lot of sense to us. And protocols are building in protections for these market makers. Cypher, Mango, for example, with TIFs, which is that time and force, which allows you to toss like a timestamp on an order. So like if there's a network problem, the blockchain's clock or like slots that pass can help prevent that, or those orders from getting lifted when chain does, resume normal operation. So I definitely think there's a lot of like under talked about or quiet features that a lot of these protocols are adding on the risk side of things for making market makers more comfortable to bring more liquidity on chain. I also think that it goes hand in hand with what I said earlier about airdrop season. I definitely think that you're going to see some teams launching, tokens via airdrops, and I think that will bring a lot of excitement and activity to the Solana ecosystem and DeFi in general, as well as like the quality of projects here are, people stuck through it through the bear market, right? And it does seem like the tides are turning a little bit. Who knows with macro? But I think there is a lot of positive sentiment around what protocols have been built on the kind of larger side, on the liquidity side of things for market makers and just trading shops in general to be coming back to Solana. And that's the flywheel. It's the chicken and the egg. Can you get the liquidity for the users? And I think that there's a lot of teams working really hard to get that done. And so I think we'll see, over the next couple months, airdrops, big liquidity coming back, and therefore just attracts more and more users. And there's definitely some stealth projects that are coming out that are gonna aid that excitement as well. And I think that it goes to show that Grizzlython had the most submissions ever, right? In like what seems to be the darkest hours for Solana, and people are still here, building. And I think that goes to show that this ecosystem isn't like rolling over and tossing up their hands and going, all right, it's over. And I think that resiliency, being able to make it through the ups and downs of markets, right, shows that it's going to be here for the long term and increases people's willingness to come on chain, come to Solana, because there is less concern that teams are just going to toss their hands up and walk away. Because I don't know how, like, it can get worse. It can always get worse, right? But to make it through, network outages, macro environment, FTX, Alameda saga, right, and be here and still have the willingness to trudge on, I think we've seen like Ethereum people go like, hey, like, look, like, they seem like they're going to make it, right? Like even the bankless guys have, shown positive sentiment around the Solana ecosystem and its willingness to stay around. And I think that it being probably the next most robust ecosystem to Ethereum and making it through, the turbulence that it has will go a long way as well. And again, like, there's going to be some fun airdrops coming. And so I think that, DeFi will be back in the not too distant future, and everybody will be, on the bull train again for Solana ecosystem.
Yeah. No, I think what's very clear just from talking to you in this episode and watching the Solana ecosystem power through all of these hurdles over the past year and a half, it's crystal clear that it'd be unwise to bet against Solana at this point, and the risk profile seems almost unbelievably asymmetric here in terms of the upside versus how much farther can we really go down. So amazing way to kind of end this episode on a bullish note for Solana, indeed.
Yeah, I think there's a ton of excitement. So, and thank you guys so much for having me on to talk about Solana DeFi. I definitely think all the viewers, keep your eyes peeled. It's going to be an exciting couple of quarters and onward.
Awesome. Well, this was another episode of Unlayered with Barrett, founder of Cypher.
Oh, thanks guys. I had a blast.